Welcome to our annual credit outlook. This outlook is in two parts. The first will talk about our broad view on the credit environment and credit macro in India. And the second portion, we will take you through our detailed outlook on different sectors that we track. Corporate India today is much better placed compared to where we were a couple of years ago. Companies have taken advantage of the low rates and the huge amount of liquidity available in the system to de-lever their balance sheet, to reduce the cost of financing, and to correct the asset liability mismatches that they had. Additionally, we've seen corporate India actually taking advantage of the exuberant equity markets to raise fair amount of equity and thereby de-lever their balance sheets. And we are actually seeing this in terms of numbers. The RBI puts out data on about over 2,700 non-PSU, non-financial companies. And we see that the various debt as well as operating metrics today are much better than where they were, say, pre-COVID. Similarly, rating upgrade to downgrade ratios have tracked in a similar manner. CRISIL's upgrade to downgrade ratio ending September 2021 was at 2.96 times versus less than 0.5 a year before that. All this goes to prove that today, in terms of credit health and credit worthiness, corporate India is doing exceedingly well. We'll now take you through each of the sectors that we track in detail.
In road sector, NHA and the MRTH are the main demand drivers. Collectively, capital value of the projects awarded in FY21 was about 1.71 lakh crore, which is almost double than FY19 level. Despite the COVID-related challenges in FY21, road execution was approximately 36.5 kilometers a day as compared to 28 kilometers a day in FY20, as NHA took various measures to boost the liquidity of the EPC contracting companies. With a thrust on building express highways across the country, average size of the projects have been increasing for the past couple of years. About 10,500 kilometers of the expressways are expected to get operational over the next 2 to 3 years, which is approximately 5 times of existing express highways in the country. Meanwhile, competition has been steadily rising in this sector, as NHA has relaxed the bidding criteria for the projects. That led to increase in the competition in order to give boost to the small contractors. With the penetration of FASTag, toll collection in FY21 increased substantially to 28,500 crore, despite having COVID-related years. Between 2019 to 2021, many developers delivered their balance sheet in order to unlock their capital value, pay off the debts, as well as to create liquidity. During this period, approximately 36,000 crores of the projects were monetized. And as per the CRISIL estimate, about 70,000 crores of the projects are expected to get monetized over the next couple of years. NHA is the largest demand driver in the country. And with the adoption of the EPC and HAM model over the BOT1, the debt increased exponentially to about 3.2 lakh crore. Now NHA is looking to monetize these projects and raise about 2 to 3 lakh crore in next couple of years, especially through the InvIT route for the next growth cycle. So overall, we remain positive on the sector. And as NHA is expected to provide projects on the EPC and HAM basis, companies with unlevered balance sheets are expected to do better. Meanwhile, their profitability can be under pressure due to the rising material cost.
We'll briefly discuss recovery challenges and outlook for the automobile sector. On a YTD FY22 basis, two-wheeler, three-wheelers and CV domestic volumes have been falling behind FY19 and FY20 levels. Three-wheeler has been worse affected, and two-wheeler volumes on a YTD basis have been lower versus FY21. Tractors have done well versus also PV has done well. Tractors better than PV versus previous years. As per the FADA data, we see that the 42-day festive season was one of the worst in the decade, and that the retail sales were down by about 18%. That's primarily because of lower sales in the PV segment and the two-wheeler segment. Coming to the challenges, raw material price surge was abundantly seen in the sector. Multiple price hikes were taken by OEMs, and this led to higher cost of acquisition by multiple OEMs who took the price hikes. Preference for compact UVs continued, with which we find that compact UVs are kind of cannibalizing large cars, and compact UVs were also the share of compact UVs within the PV segment also started growing. Chip shortage led to production losses. This also led to large waiting periods. It led to a big backlog, 4.5 to 5 lakh units of backlog in the PV segment, and dealer inventory shrinking to 8 to 10 days December end. On the two-wheeler segment, we find on a YTD basis, scooter sales were impacted significantly due to dull festive sales, multiple price hikes, and also higher fuel cost, and also due to weaker income sentiments in the rural areas due to COVID second wave. In the CV segment, we found that the profitability of transporters and fleet operators were dented. This was due to low fleet utilization, low freight rates, and not getting adequate freight hikes versus the diesel price hikes, and also due to risk-averse financials. Coming to the outlook for this year and the next year, we note that the growth projections that we are mentioning here would be primarily not taking into account any future COVID waves or any future disruptions. So two-wheeler will be in a negative trajectory, 1 to 3% negative, followed by 6 to 10% growth in FY23. Tractors will be flattish to 5% negative in FY22 versus 3 to 8% growth in FY23. Passenger vehicles will be 9 to 12% growth this year, followed by 12 to 16% growth in FY23. And commercial vehicles will be 19 to 22% growth this year, followed by 13 to 18% growth in the next year. That's briefly on the recovery challenges and outlook for the automobile sector.
I'll talk about the power sector. Power demand growth is one of the key indicators of the overall economic activity. Over the past 2 years of COVID, we have seen significant fluctuation in power demand, with demand going down by 25% during CY20 to about 120 gigawatt, and then rebounding to all-time high to 200 gigawatt during CY21. On an overall basis, power demand is higher than pre-COVID level, which indicate improved industrial activity and normalization of economy. We expect that overall power demand would grow by 6% during FY23. With the expected improvement in power demand, we expect that thermal plant load factor would increase to 60% in FY23 as compared to 51% in FY21. We have seen that performance of thermal players got impacted in Q2 22, mainly due to coal shortage, which resulted in increase in e-auction premium to 100% as compared to average premium price of around 25%. Higher coal price coupled with higher power demand resulted in demand-supply mismatch and a spike in merchant price to as high as 8 rupees per unit. Dispatch of coal by Coal India to power sector have started normalizing on a year-on-year basis to 25% as compared to 14% in August 21. We expect that coal shortage situation would normalize shortly and the merchant price would go back to normal level of 3 to 3.5 rupees per unit. On a renewable front, we expect that with the introduction of basic custom duty of around 40% from April 20 and GST of 5%, solar tariff would move up from the current level of 2.25 rupees per unit. On operating front, performance of solar segment is better than wind due to its lower variability in generation as well as better payment track record demonstrated by them, which bode well from credit perspectives. We expect that future capacity addition in generation segment would be driven mainly by renewable due to their competitive tariff, low gestation period, as well as government-focused scheme like PLI, coupled with carbon emission reduction norms. We expect that solar capacity as a percentage of overall capacity mix would increase from 10% to 15% in FY23. Coming to transmission sector, it is one of the segment which was least impacted by COVID, and transmission player demonstrated line availability as high as 95% and collection efficiency of more than 100% in HY22. Although there was dip in collection in Q1 22 because of lockdown restrictions. Outlook for transmission sectors remain positive due to high collection efficiency, lower revenue risk, a robust business model where the revenue is linked with availability rather than power flow. Coming to distribution segment, state distribution overdues remain elevated at around 1,20,000 crores in spite of government liquidity infusion scheme of 1,30,000 crores. Outlook for state distribution segment remain negative due to their weak operative efficiency, high losses, lack of timely and adequate tariff revisions, and high debt levels. On private distribution companies, we have observed in the past that privatization of DISCOM resulted in significant improvement in performance, including reduction in AT&C losses for certain cycles from as high as 60% to 12 to 15% now. We remain quite opportunistic for private distribution players given their regulatory business model.
Talking about first residential real estate segment, if we talk about the launches in Q3 CY21, launches were up 21% sequentially, and the trend is expected to continue in Q4 also on the back of the festive demand. Coming to the sales number in Q3 CY21, sales grew 65%, much higher than the 34% during Q3 CY20, showing the faster recovery post second wave of COVID. Low interest rates, stable prices, and waiver of stamp duty in the certain states are driving the demand in the residential real estate segment. Prices across all the market except Hyderabad market remain stagnant. In Hyderabad market, price recovery can be seen substantially, and that also led to launches of the projects. Talking about the market share of the large real estate developers, during the pandemic, people's preferences tilted in favor of the large real estate developers. Sales of the top 9 real estate developers increased substantially to about 11 to 12% due to their ability to complete projects in time, as well as their overall financial standing. Coming to the commercial real estate sector, absorption during Q2 and Q3 of CY21 was higher as compared to corresponding period last year, showing the improved market sentiments. On Q1Q basis, rent across various markets remained stagnant during Q3 CY21. Meanwhile, on YOY basis, Hyderabad and Bengaluru markets showed nearly 3% increase in the rentals. Overall vacancy level has been steadily growing across all the markets, mainly on account of lower absorption and the faster completion. This vacancy can further increase due to lower, albeit at the lower rate, due to the improving confidence level. Although ITES sector has been a dominant sector in terms of space absorption, meanwhile manufacturing as well as healthcare sector is also showing good demand. During Q3 of CY21, demand from the co-working space was also green offshore, showing the early sign of recovery in the commercial real estate segment. So overall, our outlook on the residential as well as commercial real estate sectors are positive.
Let's talk about metals. 2021 proved as one of the best year for commodity sector, driven by strong bounce back in demand and multiple price hike. The domestic price improved by 60% over 2022 with respect to HRC, while aluminium and zinc price increased 40% and 30% respectively, boosting the earning of metal companies to multi-year high. After strong demand growth in 2021, we expect 2022 will see moderation in demand as well as prices. In metal segment, China is the key contributor of global demand supply since it contributes about 50% of the global production and consumption. Of late, we have seen China is following disciplined approach for production and export of steel due to its carbon emission norms. This, along with lower demand from China's property segment, we expect steel demand of China to fall by 2% in CY22, while global demand in steel would increase by 1%. We believe that although China led the first leg of recovery in the global steel market for large part of CY21, going forward, the sustenance of upcycle would depend on continuation of healthy demand outside China. Coming on domestic steel market, demand pickup is slow, mainly due to lower restocking demand in anticipation of lower prices and gradual normalization from auto segment due to semiconductor issues. We expect that with a pickup in common spending on infrastructure, real estate, and auto production, overall demand recovery would be 6 to 7% during FY23 in the steel segment. We expect a domestic HRC price to correct by 8 to 10% in CY22 from current level. And a significant downside in price more than 10% would be partially mitigated by lower expected supply in China and higher coking coal prices. On raw material front, we have seen large fluctuation in prices of coking coal from $200 per ton to around $400 per ton, and for iron ore, which has increased from rupees 2,500 rupees per ton to 6,500 rupees per ton. We expect that with the improvement in supply from Odisha iron ore mines, domestic iron ore price will moderate from current level. With respect to coking coal, we expect that the current supply issues are temporary and prices are expected to correct in FY23, although they would remain at an elevated level for the next 3 to 6 months. We expect that spread of steel players would moderate in line with expected lower steel price in CY22, although it would still remain high compared to last cycle average. We have seen that during FY21-22, many large steel players have deleveraged their balance sheet. Although large capex of 80,000 crores is announced for the next 3 to 4 years, we expect that industry margin as well as credit metrics would improve due to improved profitability and reduced leverage, with net debt to EBITDA for the sector is expected to reduce to 2x level in FY23 compared to 15x in FY2016. Debt servicing capability is expected to be better following extended period of deleveraging. Based on this, we remain quite positive for domestic steel players. Coming to base metals, global aluminium demand is expected to be strong, led by overall industrial recovery and green cycle in play. With a strong global demand and limited supply due to slowing capacity addition in China and lack of new growth projects outside China, global aluminum market deficit is expected to be 1.2 million ton in CY22, which is expected to support aluminum prices over longer terms. Spreads are expected to remain high in spite of higher raw material prices. Coming to zinc, we expect that global zinc demand is likely to grow by 2.5%, while supply would grow at around 2% because of production cut in Europe due to higher power cost and supply side restriction in China. Zinc supplies is expected to reduce to 0.04 million ton in CY22 compared to 0.25 million ton in CY21. We expect zinc price to moderate from current level in second half of CY22 in anticipation of lower cost structure, although margins are expected to remain same. We would prefer to take medium-term exposure over long-term in the entire metal segment.
We are going to discuss Nbfc and HFC sector outlook for 2022. Over the past 2 years, if we see into the pandemic, Nbfcs have showed up both liquidity as well as capital levels. With shoring of capital and slower growth during the pandemic period, they are pretty well placed in terms of absorbing any kind of losses from the asset quality front. While the impact of the first wave was very low for most entities on the asset side, barring MFIs and MSMEs as an asset class, well supported by 6 months RBI moratorium, most entities kind of reached to their pre-pandemic levels by March 21. However, post second wave, if we see, most Nbfcs have seen a sharp increase in their asset quality parameters, which were reported in June and September quarter. While we feel that in most cases, peak number is behind us, and however, there will be some scarring from the second wave, and we feel that road to normalcy may be delayed one as compared to first wave. If we look at just from collection efficiency perspective, from June 21 onwards, it has picked up well. However, it has plateaued close to 100% levels, which means that overdue collections are going to require much more effort and time to collect. Also, another perspective is that, if we look at overall asset quality stress, including restructured assets and write-off post-COVID wave 2, it's much higher and significant as compared to wave 1. Coming to individual asset classes, we believe that while recovery in asset quality numbers will take time for most of the asset classes, MFIs and MSMEs continue to be most vulnerable, and they could further get impacted in case of further waves led disruptions in the economic activity. Coming to HFC as a segment, HFC asset quality numbers have also settled in a higher trajectory. However, good part is that disbursements have picked up pretty well, and continued growth with good underlying asset performance going forward should ensure that credit cost going forward at least is under control. Further restructuring window was available in case of builders also, so stressed builder segment also they would have taken care of. Coming to CV segment, second wave resulted into a sharp increase in NPA for most of the CV players. While the collection efficiencies have bounced back pretty well, however, we feel that normalization of NPA would take much more longer. Also, restructuring and government guarantee scheme should also help CV players. Further, the government thrust on infrastructure should reduce the ultimate credit losses for this segment as well. Overall, for the Nbfc, HFC as a segment, we feel that from a capital perspective, they are pretty well placed. However, asset quality numbers have gone up. Further, regulatory requirement of daily recognizing NPA would also put some pressure on the asset quality. So going forward also numbers could increase a bit. However, with sufficient capital, they should be able to take care of the losses. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।